The Reserve Bank's Monetary Policy Committee meets on December 7th, or will at least announce its decision on December 7th on whether there is a rate hike and how much. As always, before that, we have CNBC-TV18 Citizens Monetary Policy Committee meeting to discuss what the MPC could be pondering about. Joining me are Soumya, Ghosh, the Chief Economic Advisor at State Bank of India, Sajjid Chinoy, the Chief Economist of JPMorgan India, Samiran Chakraborty, the Chief Economist, Citi, India, Sonal, Varma, the Economist, Managing Director and Chief Economist at Nomura, India, and the Chairman of our committee, the Citizens Monetary Policy Committee, Dr. Pronab, former Chairman of the Statistics Commission and former Chief Statistician. Gentlemen, and Sonal, thank you very much for joining me. Sajjid, let me start with you. The global backdrop up until Thursday looked benign. The non-farm payroll suddenly gives us the feeling that the Fed may hike for longer. So what's the global backdrop that we have to tackle?
Nata, this may sound very trite, but I think the only thing that's certain is uncertainty. And I'll tell you why. All of us are talking about a big slowdown in the global economy. But the fact is the data continues to be very resilient. The US economy is growing at 1.5% in the fourth quarter. You're seeing both consumption and capital goods accelerating in the fourth quarter. Now, there again, there's a dichotomy. You've got the goods sector. The PMI for November was very disappointing, and you would think that we're in some kind of goods recession around the world. But the services sector continues to be resilient. And so even though we're expecting some kind of slowdown, there is no sense yet that over the next 6 months, a global recession is imminent. Okay. The US is holding up much stronger than expected. The European recession is shallower than once feared. China is stumbling, but the fact is the global economy continues to be quite resilient. Most importantly, any global slowdown is not resulting in a softening of labor markets, right? If you look at the NFP number that you pointed to, he has 260,000 jobs, but I think the most important number was wages last month grew at 0.6%, which is an annualized rate of 7%. Over the last 3 months, US wages are growing at 6% annualized rate. 6% wage growth in an environment of weakening productivity is not consistent with US inflation at 2%.
So what does the MPC make of this?
What it makes is you've got 3 different cross currents. Number one, global growth is going to slow. There'll be some disinflation from that India's MPC will take into account. Yes. But will global inflation slow enough for the Fed to stop at 5%? Potentially not. I think the risks now are that both the Fed and the ECB will raise rates beyond what markets are expecting. And once that begins to get priced in, you could easily flip back to an environment of a stronger dollar where EMs are under pressure. So the cross currents are slowing growth, but sticky services inflation, sticky wages, and a Fed that could keep moving beyond what we think.
What do you think, Soumya? Should we be, at the moment, I think the market is penciling in up to 5%. You think the MPC should prepare for something more, and so accordingly their stance, everything should be still kept open?
No, I think, Lata, I agree with Sajid's view. I think US labor markets have been uncharacteristically strong, resilient, and it doesn't see any signs of bucking down. Okay. If I add to this, wage growth is annualized 7%, which is much higher than the 2% target which the Fed is. There is also another aspect to the US labor market which is going to keep it tight maybe for an extended period next year, is that there was a report recently which says that 10 million in the age group of 23 to 54 is missing from the labor force because US employers are now looking at people who are actually needs to be more skilled. So if that is happens after COVID, and so if that is the case, we are in a situation of an US labor market which is going to have a high vacancy rate, low unemployment rate. So therefore, the quantum of rate hikes which the Fed was looking into, and the issue is that Fed has now committed itself to a 50 basis point rate hike, climbed down from 75 in December. Beyond December, there could be more rate hikes by the Fed. Magnitude of that could be lower than 50 or equivalent to 50, but the moot point is that it will move beyond 5. So that could actually materially change the outlook of the emerging market economies in terms of a rate hike, in terms of where do they need to stop. Because if that is the case, I think it will be difficult for the markets to absorb rates which looks now imminently higher than the terminal rate of 5%.
Okay. Well, Samiran, before I come to you, let me get Sonal in. Sonal, do you think, therefore, that the December 7th decision will have to seriously ponder what comes after? Maybe this decision is easy, but what they signal will be more important.
Yeah, Lata, I think that's exactly going to be the case. While December is, in our view, for various reasons, a step down, I think the bigger discussion this time around needs to be on the path forward. Because I think a lot of the discussion, not just globally, but also in India, is around a lot of coincident indicators like labor market, services inflation being sticky. We know for a fact that in a business cycle, the slowdown starts with the housing and the industrial sector, gradually feeds through into the labor market, and with a lag is actually going to show up into wages and services inflation. In our view, the fact that US labor market is so sticky suggests that yes, the Fed funds rate is likely to be higher than what markets are pricing in, but also lowers the probability of a soft landing. So we do actually firmly believe that both US and Europe are headed into a recession. And therefore, the global growth outlook for 2023 is going to be significantly weaker than currently expected. And therefore, from the MPC standpoint, Lata, I think the question is, we have, of course, taken policy rates in India all the way from effectively 335 to 6%. We know that monetary policy works with lag. We need to therefore take into account not just the lags of domestic policy, but also the spillover from global slowdown into domestic growth and domestic inflation next year. So that's essentially, I think, the bigger question this time around. What happens next? Rather than what happens on 7th of December.
Okay, it gives me the feeling that Sonal believes that things will be even softer next year, and maybe the need to hike maybe less. But anyway, first, Samiran, the big issue also is current account deficit. The dollar has walked away from the 114 levels significantly. Is that a lesser problem to address this time at all?
Definitely. I mean, part of the reason why we are looking at this global backdrop is the nominal interest rate differential between India and US, and to some extent we are worried that that gap is going to narrow too fast if Fed has to hike more than what markets are expecting today. If for some reason the dollar cycle turns, which obviously is connected to the Fed rate view as well, then there's a possibility that RBI might have some leeway in not hiking as much. Not just because of the simple USD INR issue, but also because of two other things. One, when the dollar cycle turns, typically we see capital flows to EM improve. And the second is that optically the RBI's FX reserves numbers look to be much better. So that creates this perception in the market that RBI has more ability to intervene and stabilize the currency. So the speculative pressure on the currency also reduces. So from a financial stability standpoint, yes, a turning of the dollar cycle definitely is a positive for RBI.
Okay, so the hawkish part is that the US inflation may remain longer higher because of labor market issues. But the positive could be that the pressure on the current account deficit and, as Sonal says, possible slowdown in the global economy could weigh.
The challenge is that if Fed has to hike more, then would dollar remain weak?
Whether it goes back.
Whether it can go back up or not. I think
Time permitting, I'll come back to that. Yeah. But we have not tackled the most important mandate for the for the MPC, which is inflation. Dr. Sen, on that, sir, do you think inflation, as per the Reserve Bank's forecast, will come down to 5.8 and to 5.2? So it's less of a problem. The Reserve Bank can signal lowering of rates because inflation is not the monster it was?
Well, Lata, I mean, one can't be entirely sanguine about that. I mean, the points that all my colleagues on the panel have been making seems to suggest that next year is going to, in fact, be a bigger challenge than this year. This year, things look much more predictable. Next year isn't. And so one has to be a little careful about this. Now, one of the things which goes in RBI's favor is the fact that the commodity prices, which actually led to our inflationary process, those have stabilized and have started to moderate. Now, even if the global economy doesn't perform as badly as people were expecting a couple of months back, I don't think commodity prices are going to go any place. If the global economy is weaker, then commodity prices may actually decline. So that makes the uncertainty even more. But on the other hand, really the critical issue at the moment is the fact that the dollar has weakened, which means that the imported inflation we are getting through the exchange rate, that has moderated and probably almost gone away. Now, if the dollars actually starts getting stronger, then this process becomes even more in the favor of the RBI. And it can actually take a much more sort of softer stance, as it were. But I think we're now in a situation where RBI really needs to take a call about the decision it takes now and then go to a position where it can shift either way, because we don't know what the global economy is going to be doing. And I think we need a two-way flexibility next year.
Okay, so the stance becomes very important in that case, and the wording of the stance. But the rate decision is what is more important. I'm going to change the tack a bit. Let us vote now on the rate. Let us get our guests to vote. We will discuss the stance and the take of the MPC's take on the stance in after the break. But first, gentlemen and Sonal, if you can tell me, what is the Reserve Bank expected to do on December 7th to the repo rate? Soumya.
We are penciling in a 35 basis point rate hike.
Okay. Sajjid?
A 35 basis point rate hike.
Samiran?
Same 35 basis.
Okay, this is getting easy for the chairman. Sonal?
35.
35, okay. Dr. Sen, you go with your panel or you're different?
Unanimous.
Unanimous, okay. 35 basis rate hike is what the Citizens MPC is voting for, but everyone's pointing out that the RBI may have to change the stance. So that important question after the break.